Good morning. Happy Monday. Hope everyone enjoyed their holiday weekend. Wanted to talk today a little bit about two very basic investment vehicles, and those are mutual funds and ETFs. They have a lot of things in common, and they have a few things that differentiate them. And I want to talk a little bit about both. So, starting with the similarities, both mutual funds and ETFs are excellent ways to take a diversified approach to investing, which is something we should all strive for, to have a balanced, diversified portfolio. And because of the fact that in an ETF and a mutual fund, you're getting a broad exposure. You're not just investing in one stock, you're investing in a group of stocks that can be a large, wide-ranging group, an entire index or an entire country, or it can be a little bit narrower where it's just a sector or an industry, just like a tech ETF with only technology companies, for example. Because of that structure, it's inherently a much less risky way to invest, and it's a lot easier as well because you're not having to research each one of these stocks yourself, and you're not having to try to pick that diamond in the rough where you're trying to find that one company out of the thousands and thousands that may be out there. So those are kind of some of the most basic factors that these things have in common. And now to contrast them a little bit, starting with mutual funds. Mutual funds are actively managed funds. And what that means is that you're essentially betting or investing in an individual mutual fund manager. This guy or girl or small team of people is going in each day and trying to identify these companies, trying to do that research I was referring to before, trying to pick the best companies or the best asset classes and group them together into the fund. So you need to do your research and due diligence on this individual manager or small firm to make sure you trust them and make sure they have a good track record and all that, because that's essentially what you're investing in. And because of that kind of structure, most often the managers in the mutual fund managers tend to be experts in a certain area. For instance, you might get a mining expert that manages a mining mutual fund. So most of the time, generally speaking, mutual funds are a little bit narrower. They're a little bit more sector focused, and they might be weighted in such a way that the manager has identified really the greatest companies in that sector and has invested accordingly as he or she has seen the opportunity. So mutual funds, it is important to note, these are typically not traded throughout the day. They have a portfolio of holdings, and those holdings are calculated at the end of each trading day, and that is determined what's called the net asset value of the mutual fund. So you can't really invest whenever you want. It's usually only one opportunity per day to invest in a mutual fund. So they're not as liquid, let's say, as ETFs. So with ETFs, unlike mutual funds, ETFs are passively managed. What that means is that you're getting a much broader exposure. You're investing in a fund company. Now the company you're investing in an institution, which you need to do your due diligence and your own research on that institution to make sure they are reputable and they can be trusted to manage the fund. So typically, because an ETF is managed by an institution, it usually has a lot larger holdings, and it's typically a broader scope. ETFs also include index funds. You might hear this term index funds. Those are essentially ETFs that cover an entire index. So like the S&P 500 index fund, that's an ETF. Okay, and you're getting exposure to an entire index of stocks in that case, and there's really no one stock that's typically weighted more than any other one because they just want you to have an even exposure to the entire index so that when the index moves up, the ETF moves up accordingly as well. So because of that, they're typically more diversified. There's no real big positions in any one company. Typically speaking. So even though you can get a sector ETF or something like that, that you can narrow it down a little bit. They're usually not weighted in such a way where one company has the bulk of the holdings, like can be in a mutual fund. Also with ETFs, just a final point, that they are more liquid. They're traded like stocks. They're traded at any point throughout the day. If I wanted to go and buy 500 shares of an S&P 500 index fund right now, or an ETF of technology, I could go do that right now, and it's going to give me a price, and it's going to move up and down throughout the day. So it's traded essentially just like a stock. So hope that shed some light for some people, provides a little bit of insight. And I'll just leave you with the question to start the week off. What sectors you guys like? Over the next 5 or 10 years, what sector in the market or what index do you think is going to perform the best? Hope that helps. Have a great day.